It's Wednesday, August 7th, and this is Markets Daily, hosted by me, Jen Sanasie. On this show, we navigate the currents shaping the crypto markets, providing insights against the broader financial landscape. So, whether you're actively trading or simply fascinated by the volatility of crypto markets, this show is your compass to understanding what's happened, where we are, and where we're going. Good morning, everyone. Happy Wednesday. Now, we've been talking a lot about crypto and the elections. It's been a super hot topic here in the industry. Many folks who have come on this show have said that this needs to be a bipartisan issue if we expect to see any movement on legislation here in the United States. Now, Coinbase's chief legal officer, Paul Grewal, is getting in on the conversation. He said in an interview at the Asia Blockchain Summit, "My number one concern is that crypto becomes politicized and becomes a partisan issue in ways that, at the very least, slow and perhaps even worse, threaten its continued growth and development. There needs to be an understanding that the Howey Test was developed in the context of an orange grove real estate in Florida in the 1940s and 50s. He said, arguing that applying the Howey Test blindly and mechanically to blockchains and crypto does not make practical sense. This is sentiment that has long been expressed by many in the crypto industry, and yet SEC Chair Gary Gensler stands by his stance that no new rules are needed for crypto. Today, we're going to talk all about the Howey Test, what it is, how it works, why it remains a contentious issue, and why it's relevant to investors like you. The Howey Test is a legal standard used in the United States to determine whether a transaction qualifies as an investment contract and thus would be considered a security under federal law. It originates from 1946. It comes from a 1946 Supreme Court case, SEC versus WJ Howey Co., involving a Florida citrus grove. Now, the court's decision laid down a four-part test, and it goes like this: an investment of money in a common enterprise with an expectation of profits solely from the efforts of others. Now, if all of these elements are met, the transaction is deemed a security, meaning that it falls under the regulatory purview of the SEC. So, how does this apply to cryptocurrencies? Well, the application of the Howey Test to the crypto world is where things get interesting, controversial, and kind of murky. Many projects have been scrutinized under this test. The SEC has argued that numerous tokens and coins are essentially offering securities without proper registration based on this Howey criteria. Let's break down how each part of the Howey Test might apply to a cryptocurrency or a token offering. Investment of money. To participate in many coins or tokens, participants invest their money in exchange for a new cryptocurrency or token. Common enterprise. This is often satisfied in the crypto space as the success of the investment is usually linked to the success of the project as a whole. Expectations of profits. Investors typically expect to profit from their investment through the appreciation of the token's value. And efforts of others. This is where it gets a little heated. If the success of the project relies heavily on the efforts of a centralized group or company, it leans towards being a security. So, why is the Howey Test so controversial when it comes to crypto? For starters, this industry is incredibly diverse. Tokens serve numerous functions beyond just investment. They can be used for accessing services, governance, or as a medium of exchange within a specific ecosystem. This multifunctionality makes it challenging to apply to a one-size-fits-all test like Howey. Moreover, the decentralized nature of many blockchain projects further complicates things. For example, Bitcoin is generally considered decentralized enough that its tokens are not deemed securities. But what about newer projects that start with a centralized development team? At what point, if ever, do they transition out of being considered a security? This ambiguity has led to a lot of uncertainty and frustration in this industry. If you follow the crypto news, I'm sure that you've noticed that. Crypto projects argue that the Howey Test is a tool from the mid 20th century. It's ill equipped to handle the nuances of modern decentralized technologies, and they're calling for clearer guidelines and perhaps even new legislation that better fits the unique characteristics of digital assets. On the other hand, regulators maintain that the Howey Test is flexible enough to apply to various scenarios and is essential for protecting investors from fraudulent schemes. They argue that many ICOs and token offerings are, in essence, modern day securities offerings and should be regulated as such to ensure transparency and accountability. Now, why is this relevant to our crypto markets today? Well, the classification of a crypto asset as a security has significant implications. If deemed a security, a cryptocurrency must comply with a host of regulatory requirements, including registration with the SEC, disclosure obligations, and investor protection measures. This can impose substantial costs and operational hurdles for crypto projects. For investors, understanding whether a token is classified as a security is crucial. It affects how you legally buy, sell, and trade these assets. It also influences the overall market perception and value of the token. Projects that fail to comply with securities laws may face legal action, leading to fines, refunds to investors, or even the shutdown of projects. This regulatory risk can create volatility and uncertainty in the crypto markets, impacting investor confidence and market stability. As we've discussed on this show, the global nature of crypto markets means that U.S. regulatory decisions can have far reaching effects. Other countries may take cues from the SEC's actions, leading to a more standardized approach to crypto regulation worldwide. This can either foster innovation by providing clearer guidelines or stifle it through stringent controls. For now, the Howey Test plays a crucial role in the regulatory landscape of cryptocurrencies. Coinbase's Paul Grewal said at the summit, precedents, even from the Supreme Court, have always been recognized as applying in particular contexts and needing to adapt to new technologies and issues that emerge in markets and in the economy more generally. He added, it's important to respect precedents and to use the wisdom garnered from decades of applying them in all sorts of other contexts without being beholden to them in a way that just doesn't make practical sense. All right, we'll leave it there for today's show. Thank you so much for listening and coming on this journey with me to better understand the crypto markets. If you enjoyed today's show, subscribe to the CoinDesk Podcast Network. That is available anywhere you find a podcast. Give us a 5-star rating. If you prefer to watch on video, subscribe to our YouTube channel and hit that like button. Your support means the world. We hope you have a fantastic day, and we'll see you tomorrow.